Hello, I'm Max Reiboldt with Coker Group, and it's great to be at another Garfunkel Wild ASC conference. Today, Bob Goettling and myself will partner on the subject of private equity transactions for ASCs. And we hope to answer several questions that revolve around those entities and those services. We have a full agenda for today's presentation. And so without further ado, I'm going to go ahead and get started and look forward to our discussion today. I think most of us understand and know what private equity is, so I'm going to be brief when it comes to an explanation. We all know that these are private investors, generally speaking, and in the context of what they do, and specifically in ASC transactions, it is an acquisition and then a post-transaction working relationship. Many private equity companies are really looking for a long-term investment, but there are caveats to that, as we'll get into as we discuss further today. Suffice it to say that private equity is very interested in ASCs. Many times the practices that are akin to the ASCs will be a part of the transaction as well. Let's say, for example, if we're an orthopedic group, often the orthopedic surgeons may have a separate investment in a separate legal entity, that's the surgery center, and yet the private equity transaction is working with both the practice as well as the ASC. So today we'll talk about those aspects of both of them in the context of mostly ASC transactions. So why are private equity funds of so much interest these days? Well, first of all, the structure of their transaction is such that many ASCs are a perfect fit. ASCs are often very profitable, sometimes more than others, of course, and yet that's a very attractive thing for private equity investors because indeed they're looking for a good return on their investment. At the same time, it's a dynamic and a very competitive market that we see today. ASCs are likewise attractive to hospitals, and so we'll delve ever so briefly into that, more so in the context of them being an alternative to private equity firms. Likewise, private equity is looking at critical mass, meaning that they look for more than just one acquisition. Now, if you have multiple ASCs, that would be of interest, but often it's a single ASC owned by a certain group, and then they'll use that as perhaps an initial acquisition target and use it as a platform to aggregate and put together a number of ASC transactions within a particular region. So how does the typical private equity transaction look and what's composed of it? Well, for practices, again, I'll be brief, there typically is a compensation reduction because physician compensation is a major part of the practice financial statement, as we all know. Roughly half or more of the bottom line, if you will, is shared by the partners or the physicians together. Some meaning not fully physician partners, but the providers, as we call it. And so in order to maintain a level of compensation within a private equity practice transaction, there has to be remaining income to the doctors or they will not make a living. So what we typically do in a private equity transaction is reduce the compensation that grosses up the earnings and allows us to apply a multiple or even an income approach utilizing excess earnings to derive upfront value. Well, ASC transactions don't have physician compensation per se. They may have medical directorships, but that would be it. They have profit, bottom line, true bottom line, like most other businesses. And so that profit can be capitalized under an income approach, or we could apply a multiple of the EBITDA and derive value. And so simply stated, that's how a private equity transaction with an ASC will generally formulate. Now, with that in mind, there are some areas of consideration, some of which are compliance related, and we'll touch on those here in just a moment, again, somewhat briefly. But for the main area of consideration, private equity and ASCs can really function as a pretty traditional type of business, meaning that there's no physician compensation reduction, there's no, we call it haircut. It can be a pretty straightforward transaction. And with that in mind, there can be some post-transaction opportunities for growth in the original purchase, because often the ASC that is owned by physician surgeons being sold to a private equity fund is not they are not selling the entire equity base. In fact, many private equity firms will want a minority interest to be retained by the sellers, which again are, generally speaking, physician surgeons. So why would physicians want to do this? Well, it offers a partner. It also offers an exit strategy, particularly for some of the older physicians. And frankly, it offers an ability for what we call the second bite of the apple, which is the subsequent sale down the road of that minority interest along with the private equity's majority interest. So these are all opportunities that are availed in such transactions. What about where we are in 2020? Obviously, we've dealt with a lot of adjustments in 2020 with COVID-19 and the whole pandemic and what it's done to all businesses, and particularly ASCs in this case. We find that there has been, most likely in pretty much everywhere, somewhat of a slowdown of private equity transactions in ASCs in 2020. The good news, however, though, is I think there are going to be a significant amount of pickup in transactions, and the market is clearly bullish and robust for private equity models. Now, I mentioned a moment ago that there was the potential of having a hospital as a competitor. Hospitals are certainly in the market. They deserve to be a part of this. They're certainly a major important factor. So we're not here today to in any way, shape, or form be critical of hospitals. Indeed, quite the opposite. But hospitals are challenged to replicate a private equity transaction that is able to be done for practices, and again, trailing that is often the ASCs. So here's an example, and again, it's only a brief example of how a hospital might be able to compete with a private equity firm's transaction for purchase of a practice, and again, trailing that would be an accompanying ASC. And essentially, we call this a private equity-like transaction. It's nothing particularly innovative in the sense that under the practice guidelines, again, all the profits are distributed from the practice to the physician. So there's essentially no excess earnings or no profit once that's done. Therefore, there's very little upfront value, as we know, in a typical hospital practice transaction. There can be similar value in the ASC, but oftentimes you can't get to the ASC if you don't buy the practice first. And that's becoming more and more the case in many instances. So what we do in this instance is, if there's some upfront money, and particularly this would apply to a specialty practice and a large one, I might add, usually typically with a number of providers, we simply take the same approach. We reduce the compensation, gross up the earnings, and create some additional value up front. And that's how hospitals can sometimes compete with private equity acquisitions of practices when the practices do want a fair amount of upfront money. So these things are all something that we can consider, and again, they're often a preceding of an ASC transaction. So within these models, we have a good bit of flexibility as such. Now let's talk a little bit about some of the regulatory compliance differences between PE firms and hospital transactions, because again, it's very relevant, and most PE firms consider their major competitor for acquisition excuse me, of ASCs to be hospitals. First of all these things need to be looked at as part of, that are on the screen here, that are part of the due diligence and the overall putting together of the transaction, whether it's hospital or private equity. There are fraud and abuse issues that need to be considered, and there's always the separation of the clinical practice from non-clinical assets and personnel. There may be licensure issues as well, and certainly antitrust issues could be a part of the differential. We find these sometimes to be the case with both hospitals and ASCs as such. The typical transaction can become very complex, and that's where great firms like Garfunkel Weil come into play, obviously, to lend significant legal expertise. Taxes are also a part of this, depending upon the structure of the ASC. They can be even more challenging for a not-for-profit hospital in some cases, because the hospital may be buying the ASC and wanting to maintain it as a for-profit entity. These are not typically as much of a challenge for a private equity firm, because needless to say, they're almost universally for-profit entities. There are some issues relative to the type of legal structure vis-a-vis a S Corp or a C Corp or an LLC of the ASC, that legal structure. And so there's always the consideration as well of exactly what and how, from a tax treatment standpoint, the gain, and usually there is a gain, going to the physicians will be. All these things need to be considered, and simply stated for the moment, we would suggest strongly that as you're entertaining an ASC transaction with a private equity firm in this case, that you really get very strong and competent healthcare advisors, consultants that can put the deal together, do the valuation work, etc. Plus, of course, experts in the legal field as well as the actual tax considerations as well. Now, let's look at valuation considerations more firsthand, and this is a very simple example, but I felt it was important to note and provide a very simple illustration of how the valuation works. So in this case, if we are being acquired, the ASC, by a private equity firm, we're typically going to get to an EBITDA number, and that in and of itself can be a little bit more extensive process than the one line you see here. And then we assign a multiple. Now, please don't pay any attention to the multiple. The multiples can vary with the type of ASC, where it is, how long it's been in existence, multi-single specialty, whatever it might be. We just simply use the example of a 5 because it is not very high and it's not that low. It's kind of in the middle. And quite frankly, you just take the multiple of the earnings, and in this example, we're suggesting that 70% would be sold, so the proceeds would be $2.8 million. If we have 6 equal, and they're not always equal, but let's say in this case they are, physician shareholders, then the distributions before tax would be the number that you see here on the screen. It's not a very complex transaction in this manner. Getting to an EBITDA number and projecting it into the future based on where it's been in the past and where we think it's going can obviously require a more sophisticated valuation expert, which is why I mentioned a moment ago that you should always have such an expert on hand. So these are very important points, and the value of the ASC can also be derived through a discounted cash flow calculation, which would attempt to get to the earnings number, the excess earnings as we call that, apply a multiple based upon a capitalization rate, discount it to present value, and apply a residual value or terminal value as it's sometimes called within that income approach. The final amount that's derived is thus what would go to the owners, and again, that is always pre-tax. Typically, these transactions are asset purchases. They're not purchases of the legal entity. They could be, and there's pros and cons to that that I don't have the time to go into today, but suffice it to say they are very much in play and should be considered. So when we compare a private equity buyer with a hospital buyer. And I want to stop here and be sure that Bob Goettling has plenty of time to cover some additional points along these lines as we're partnering in this presentation. But I think it's worthy to note that we've tried to point out here the pros and cons on both the PE buyer and the hospital buyer for ASCs. Let me say in closing that there's no right or wrong. There's not one that's better than another. If you have an ASC, it may make a lot of sense to look first to a health system, to a hospital, particularly if you're looking to align your practice, because many PE firms are more interested in the ASCs, maybe not as much in the practice, though that's not always true. But really just keep your options open and not really close the door on either PE or hospital transactions. Look at the possibilities. And this list of pros and cons, which I don't have the time to go over in detail today, I think is pretty comprehensive. It's one that we have gathered over a number of years of doing these transactions, representing literally both sides: hospitals, PE firms, practices, ASCs, the entire mix. So with that said, I'm going to stop for now, and we're going to pick up with Bob taking off on some more points relevant to this subject. I've enjoyed our time today, and I wish you the best of good fortune as you consider private equity and, for that matter, maybe hospitals and ASC transactions. Thank you.
Thank you, Max. That was a great overview of the private equity transactions on ASCs and on practices, and also I'm glad you went into the hospital and health system type of a deal. I think that was an important update too. I'm going to stick with the topic of transactions, but I'm going to take it a little bit of a different angle on that. Still focusing on ambulatory surgery centers and physician practices, and as Max pointed out in his presentation, very, very similar, and they, as time goes on, they are having a lot more in common. So I'll be dealing with both of those. But what I'm going to try to focus on is three areas. Number one, a market update. What has happened, what's been going on, and then number two, looking at how to get deals done. How to navigate through a transaction in these crazy times. And then third, spend a little time talking about the future outlook. Where's everything going in that? First, intro. My name's Bob Goettling. As Max said, I am a principal with the Bloom organization. I have been I call it in the doctor business for over 25 years, lawyer by education, licensed investment banker. I spent the first half of my career on the buy side, actually buying. I was a founder of a physician practice management company back in the 90s that morphed into an ASC company. And I was on the buying side for 12, 13 years before I flipped over onto the other side. Now, with the Bloom organization, we are probably the largest, if not one of the largest, in representing physicians only in the surgery centers and practices and some of their ancillary businesses. So my whole career has been what I call in the doctor business. And again, as I said, the Bloom organization is a very niche investment banking firm, again, licensed investment banking firm, but representing doctors on what we call the sell side, on their practices all over the country, in all the different specialties, and then of course in surgery centers. Last year, we had over $1 billion in closed transactions in both ASCs and practices. And like I said, if we're not the biggest in doing that, we clearly are the number 1, 2, or 3 in the country. All right, so that is a little background on who I am. Let's jump into the first part of this, which is where the market is. So clearly, it goes without saying, as everyone knows, the world changed the second week of March in this year. Just as a little background with the size of what we started off in January, February, closed a couple of transactions. we were off to the busiest start in our entire history. And then all of a sudden March hit, and I can tell you it was specifically the second week in March. And from that point on with COVID, everything changed. Everything stopped. It was just like an overnight stop. And all of our transactions that were in progress, post letter of intent, down to negotiating definitive documents, they all stopped. Every one of them stopped. And from that point, for the spring, for March, April, May, all the way into the summer, it was virtually dead. It was crickets, and everyone was struggling, trying to figure out how do you get a transaction closed? Is there still the ability from the buyer's perspective to want to close transactions, and how do you do it? So you can see on this, I put together on this first slide here, you can clearly see from 2019 and then 2020, the 40 you can see right is the when the bottom fell out. And where did it fall out? In essence, if you ask me, in the healthcare services sector, it fell everywhere. But you can see over on the right side here of the slide, long-term care was down almost 33%. Behavioral care, managed care, physician medical groups down the most at 36.5%. And in that, there wasn't a separate heading on this for ambulatory surgery centers, but I can tell you the ASC transaction deal business, getting deals done, was down even more than the physician groups. From the ASC's perspective, or from the ASC company perspectives, from the health systems perspectives, there just were not any deals transacted. So it was pretty much a hold for what lasted to be several months. And you can see on this this slide here from February, March and April, and even then into May, were pretty much crickets. And when I say crickets, the folks like us, the investment bankers and the transactional attorneys, like Andrew and Greg and his team at Garfunkel, what they were all doing along with deals that were out there, were trying to figure out what do we do? Do we have to go back out to the market? Do we try to look for different buyers? How do we actually, how do we handle this? And it wasn't until, and you can see in this graph, which is why I thought this was kind of valuable, it wasn't really until the summer, until like June or July, when ideas and okay, how do we actually get deals done, started to come back into the discussion, and actually some transactions started to happen. So if you go to, so that's where the market, that's where the market was. So, and it was, it was very much uncharted territory. So anyone who said they knew what was going to happen or what was happening, they didn't. We had no idea what this, whether there would be surges back in COVID, which again, as we see today, we're almost back in that same position, trying to predict the future, which no one can do. But what we learned and what really happened in the middle part of the summer was really smart people started getting together to figure out, okay, if you have a transaction, whether it be a surgery center, an ASC, or whether it be a physician practice, that really should get done, that all the reasons, but for the COVID, all the reasons the transaction should happen, how do you make that happen? And that was the real challenge, to try to figure out how to do that. So you can see on this slide a little bit who was hit the hardest. Obviously, the elective procedures, fee-for-service reimbursement. Interesting. The reason I put that point in there about fee-for-service reimbursements hit the hardest. On the managed care side, some of the more evolved into the states or the markets where there's more evolved delivery models, it's not just fee-for-service. They're getting to population health and even to some of the at-risk contracting models, and that those companies and those organizations were hurt less. They were hurt less because they weren't necessarily shut down. They were paid regardless of the fee-for-service volume that was done. So they had a little bit better time than the normal majority of all the physicians that are still fee-for-service. Obviously, the densely populated areas because of the COVID. So then if you look on the right side there, so how can a banker help? From our perspective, we really looked at it, and we've always looked at it as in representing our physician clients and trying to figure out the right transaction and then maximize the economics of doing a transaction. And again, that applies to a surgery center or to a physician practice. It's always been about creating value and how to create value. Well, here, in the new world of this year, what that meant to us, if you can think about it, physician practices and surgery centers were closed down. They didn't do anything. So they had the months of March, April, May were in some non-existent. In others, doing just a dribble of business so that they were not, it was not a very accurate portrayal of the finances. So then, as you can imagine, and as Max alluded to on some of the different methods to value the practice or the surgery center, how do you do that? And how do you do that taking into effect the COVID thing? So what we ended up coming up with, we at Bloom, we came up with a term that we've coined. I'm sure probably there's other industries that are using similar things, but we call it, practices and surgery centers are valued on EBITDA. Everyone hears that term, EBITDA. Well, we created a new term called EBITDAC. We added a C onto the end of EBITDA, and what that actually meant was a EBITDA for valuation purposes adjusted for COVID. And so that was the real, in the summer months of trying to get transactions, again, this should be done in where you still had a very good interested buyer and a seller that everything still made sense, but for the valuation and but for the COVID on how to try to get this done. What it really came down to was allocation of risk. And what that means is that a buyer who's going to pay, and again, with all of our clients, we made an assumption, and we made the assumption, which I believe is the proper assumption, that continue to value the practice or the surgery center based on pre-COVID numbers. Forget March, April, May, whatever that time period was that everything was in the total toilet for that. Forget that and go back to the valuation of pre-COVID. Well, how do you do that? Well, you have to then make adjustments and adjust the EBITDA for those and tell a story and show how those numbers are, number one, already either, ideally already back to what they were pre-COVID, number two, on the way back, or number three, in process with a plan and a defined time period where they would get back to that pre. And so that was the adjustments that we created, or and we're still using today for what we call EBITDAC on trying to take into effect the COVID. So anyway, going back to what I said a couple of minutes ago about the issue really with getting transactions done in this COVID period or post-COVID period, so to speak, is a risk allocation. And it's if a buyer is going to pay for a business that is valued on the pre-COVID, the March 2020 numbers, they're going to need to know that those numbers, by the time, if not by the time they write the check, very shortly thereafter, those numbers are going to get back and that valuation is going to still be valid. Well, once they write the check or pay the money up front, all bets are off. So how do you allocate that risk to make that happen? So that between the buyer and the selling physicians, how do you get that done fairly so a transaction can keep going? Well, one of the interesting things that was developed would have never come about, but for this whole COVID, was this idea of a hybrid on seller notes. And so as Max was explaining on the way the private equity deals are done, the private equity firm puts up equity, they put up cash as equity, but then the rest of the purchase price, the majority of that purchase price, is usually done with bank financing. So you have a third-party bank that has to come in. Well, as you can imagine, in March, in April and May, those bankers weren't even answering their phones, and so their idea of taking the risk, they didn't know what was going, what was going to happen, and so them stepping up and doing that financing was just not happening. So in an effort to try to get transactions done, a hybrid seller note concept came up, was used on a couple of transactions where the selling physicians actually took a note and basically stepped in the place of a bank to get the transaction done, with the idea of once COVID cleared up, once things got back to normal, that a bank would be brought in and the transaction then the seller notes would be paid off. So it was a bridge, financing event, and it worked on a couple of transactions, and those transactions were the earliest in the COVID period to finally get over the line. The due diligence considerations, obviously updating as Max was, and I'm sure Max and the Coker group were very busy during the summer, updating those valuations, changing all the perspective of the way these companies were valued, given the whole episodes of those months with COVID and the unknown question mark of the future. So all that due diligence and stuff has kept going throughout the process. As I said, the lending markets clearly were one of the biggest issues that you either had to, and again, as time went on, as you got to July and August and September, they opened up more. Again, they're in the business of loaning money. So as things got better or more comfortable as a new norm, they started opening up more, and that again allowed some more transactions in the later part of the summer to continue on. The other thing that happened was there was a very much of a difference in, again, if you're looking to sell something and you're always on the sell side, if certain buyers can't buy, you look for other buyers, right? That's a pretty simple concept. So what we ended up doing is going out and finding out that there were a lot of health systems that couldn't compete. As Max explained earlier, they have a very tough time in the old world, in the pre-COVID world. They had a tough time competing with the private equity firms. Well, in this COVID world or the post-COVID world, that wasn't there. They were, they had almost an exclusive seat at the table on a lot of transactions. And so a lot of health systems got very progressive and overnight turned very sophisticated on doing transactions on both surgery centers and on practices, and in being partners on doing some of those transactions in more complicated structures going forward. Obviously, the insurance companies loved it, the Optums of the world, with their 128, I always say this because it amazes me every time I say it, $128 billion of cash on their balance sheet. So of course they were very much through this whole process in their appetite was very heavy for doing transactions, especially when other people weren't there. And then I'll talk a little bit, I have ESOPs here towards the end as the future. I'll get into a little bit more about the ESOP. So let's go to the third point that I wanted to say a couple of things on, which is M&A activity 2021 and beyond. So where do we go from here? I have to say, given all that, the craziest year ever, no one would have ever predicted it. And, I hope we're getting through it and we have the tailwinds. I will say, both on behalf of myself and all of our professionals at the Bloom organization, we really do believe that the opportunities for starting now and going in the next couple of years are going to be gigantic. That there are still the physicians that are seeing they have to do they want to do transactions, that they want to monetize and they want to prepare for the future. And so the opportunities are out there now, in addition to the private equity deals that were being done in the last couple of years. Now you have the hospitals, and as I said, you have the payers on there too, all doing transactions. So from a perspective of a sell side investment banker like me, the more buyers, the more fun in trying to maximize valuations and getting transactions done. So I wanted to speak, I got a minute or two here to finish up. I wanted to really quickly talk about some of the alternative strategies. And again, these would have come out, these are not as a result of COVID. They were already out there and becoming more popular, but just something to consider and to think about, because you're going to hear more about these. The first one is ESOP, and that stands for Employee Stock Ownership Plan. And for those of you who don't know what that is, back in the 70s, it was created as a way to equalize income, the vast disparity in incomes, to try to get that. It was the government set up some tax benefits and some other structural ways to try to incentivize business owners to sell their business to their employees. And the way they do that is through an ESOP. Very complicated transaction. The Bloom organization, our company, is an ESOP. We did it about 5 years ago. One of the best decisions we ever made. And there's a lot of reasons why it hasn't, corporate practice of medicine and other reasons why it hasn't really taken hold yet in the physician business, but we believe it's on the way. There's a few things that have been done on it. We are actually actively, I think more than any other investment bankers out there, representing companies and practices that are looking to do ESOPs. And again, there's great tax advantages of it. And the company, if it's a very aggressive and progressive company that wants to grow, it becomes a tax exempt entity on the go forward, which really puts it at an advantage against any of its competitors in being able to grow from acquisition. So that is that is something you're going to hear more about in the future. Second, a SPAC. They call it a SPAC, a special purpose acquisition company, brand new. Most of you probably never heard of this, but I'll tell you to look up something. A few weeks ago, SPACs, all the M&A lawyers and that are familiar with these. What it basically is it's a fund that's set up to allow a company to go public and go to the public markets without having to go through that huge, horrible process that a company does in going public. And so it's become very popular in the tech industry. And of course, it is now moving into healthcare. And in fact, a couple of weeks ago, one of the early on people at Facebook, who's a billionaire, who's very big into the SPAC thing, just took a SPAC into the healthcare space, a company called Cloverhealth. They did a SPAC. It was valued, and again, this blows me away, it was valued at $3.7 billion. And what this company was, it was a Medicare Advantage kind of a health company that had 57,000, that's not a lot, 57,000 Medicare Advantage lives in 7 states, and did a SPAC to go public at a valuation of 3.7 billion with a B dollars. So I think you are going to see more of the tech money and tech expertise and tech smarts coming into healthcare, and you're going to see things like the SPAC and some of these more complicated things are going to become more popular, and they're going to be things that physicians need to, whether on the large or small practice side, on their surgery center side, on their efforts to integrate a market or go to more of the risk-based contracting models away from fee-for-service. These types of things are going to come into focus a lot more. Bottom line. So the bottom line on what this all, as my final words on this, what this means. 2 things. Three things actually. Number one, always, as things get more complicated from the physician perspective on all these businesses, totally go through the process. Physicians love to go to the end and work backwards. Read the last page of the book first and then go backwards from that. You cannot do that here. This is always a process that you have to go through, and we found that the most successful physicians, practices, surgery centers that go through that process end up doing the best. And number 2, as things become more complicated, you have to, Max said this and I couldn't agree with it more, you can't have your brother-in-law, the attorney, who does divorces on the side, represent you on this transaction. You need the experts, and you need the experts like Andrew and Greg and what they built at the Garfunkel team on their team. This is all they do. And so whether it be the SPACs, whether it be the ESOPs, whether it be the value-based care models and that, they're the ones doing that. That's what you need. So you need to have all that expertise. I know I went pretty fast here. On the slides here, you see my email, rgoettling@bloomllc.com. If anybody has any questions or any follow-up thoughts, feel free to reach out to me. I'm very good at getting back to you. So with that, I appreciate this, and thank you very much.